Half-time report. The markets at this point in time continuing to remain extremely flat at an index level and choppy within a range. Mid-caps still under pressure, but the Bank Nifty, its volatility is actually now on the greener side. It's up about 0.6%, so back to its morning highs. This day can still go any which way, but there is definitely bullishness in the air. Let's get you this very important CNBC-TV18 exclusive. We spoke with Morgan Stanley's Ridham Desai on his market projections as also his top sectoral calls. He's bullish on real estate and corporate-facing banks. But the important point that he's talking about is that the Indian earnings growth story has kicked off. And for the next 5 years, every year we are going to see a growth of 20% in earnings. Listen to this very interesting conversation.
We've had a pretty strong stimulus from the government in terms of spending and therefore government capex, and we have to aggregate both SOE as well as state government and central government capex, not just central government capex. Together these numbers look like they're at all-time highs relative to GDP. So they're compensating for the lack of private capital spending. Also, what has happened notably, which I don't think we should ignore, is that 2 years more capacity has got utilized in the private sector. So right now I would estimate, or I should say guesstimate, that utilization rates are in the low 80s. And another 2 years they'll be in the low 90s. Now it's a time at which capacity needs to come on stream. So sometime in the second half this year, post-elections, I think the private sector will start debating capex.
You will not talk stocks, but what caught my attention were 2 or 3 real estate stocks. There was an overrepresentation of real estate in the list of stocks that came in the Morgan Stanley report. And this is coinciding with CLSA also putting up a slightly bullish report on real estate. You think those assets have troughed out and we should look for good stocks in that sector? My
view in January, when the elections were looking a little bit fuzzy, the election outcomes, our view was that beyond May, the market will start trading the growth cycle. So May will come and go, and the ballot will fade in importance very quickly. So yeah, I would hold on to that opinion as well. On sectors, I think if I were to characterize this in one line, I think you want to buy domestic cyclicals, both consumer cyclicals and industrial cyclicals. I think both of them look quite interesting. I think income growth is looking strong, and therefore consumption in the discretionary space should improve, which includes the likes of autos, airlines, it includes hotels, it includes a slew of sectors which are discretionary in nature. And then industrial cyclicals, which includes the host of industrials, engineering companies, construction companies, the big turnkey guys, everyone. So I think these are the 2 places that I would put money to. And then of course financials, where we would buy select non-banking financials. They have rallied, a lot of them have come back 20-25% from their lows in the last month, but they are still well off the tops. And I think a lot of the problems there have settled down. Growth in those companies may look a little bit tepid over the next year or so as they build more liquidity and capital on their balance sheets, but I think it's more or less in the price. And then of course corporate banks. We're going to get very strong earnings from corporate banks. So they are, you've got to have a bid on them all the way through. They will likely get re-rated and will report strong earnings over the next 2-3 years. So that's the space we want to be. On your question on real estate, I am very bullish on real estate, both commercial and resi. Commercial, the cycle probably troughed 2 years ago and is already on its way up. Resi, I think, will likely trough in the next 1 year or so.